Hello, welcome to this ICAEW webinar, Crypto Assets Uncovered, in association with eToro. My name is Anita Monteith and I am Tax Technical Lead and Senior Policy Advisor here at ICAEW. I will be your facilitator for today's session. Crypto assets crop up increasingly in tax discussions between investors and their agents, and we're pleased to have gathered together some experts for you here today. However, before I introduce you to our guests, I should just say it's important to understand that crypto assets may be regulated or unregulated. You can read more about the different types of assets and their status in the FCA's recent policy statement, PS 19/22. Unregulated crypto assets like Bitcoin, Ether and XRP are not covered by the Financial Services Compensation Scheme, and consumers do not have recourse to the Financial Ombudsman Service. The overriding message from regulators is buyer beware. Consumers need to exercise caution and ensure that they can understand and bear the risks involved with assets that have uncertain value. We'd very much encourage you to get involved with today's webinar. You can submit your questions to us at any time by typing a question into the question box and pressing send. The questions will come straight to us without being sent to the rest of the audience. We have allowed some time at the end of the Q&A, so do please keep them coming in. And if you have any difficulty during the webinar, perhaps with the sound, then please do just pop a question in the box as well, and we'll do our best to help you. Please take note of the widgets that you'll find at the bottom of your console. You can open and close these as needed, as well as sending in your questions. You can also download a copy of the slides and find some useful links under the resources widget. One of those is a very helpful infographic that eToro have supplied to us, and there's also a link to how you can join the ICAEW tax faculty, which I hope you will consider doing. Our speakers today are Iqbal Gandham, UK Managing Director at eToro, Dion Seymour, who is Policy and Tax Advisor at HMRC, and Michelle Robinson, Associate Director at Deloitte and member of our Private Client Committee of the Tax Faculty. Now, we thought it would be a good idea to have a couple of poll questions to get you all engaged and warmed up. So, first one for you. How would you define your knowledge of crypto assets? Be a beginner, an intermediate, or an advanced. And if you'd like to vote now, that would be great, and then we can share the results with you in just a moment. We've got plenty of votes coming in now. I think we're just about there. Let's just push them to the screen. The majority of you are beginners. Right, okay. Well, you and me both, because I have to say crypto assets are not my strength. I'm more of a business tax person. Let's move on to our second question. Have you seen an increase in the number of clients asking about crypto assets? That should be fairly straightforward. Yes or no, if you'd like to vote now, please. Of course, you may not have clients at all, in which case this won't be relevant to you. But if you are logged on as a practitioner, then go for it. Excellent. And the answer is yes. So I can see that our speakers are going to be delighted that they're talking to beginners and intermediates that have got lots and lots of questions coming in. So off you go. Iqbal, tell us more about yourself and eToro.
Thank you, and good afternoon to everyone out there. Just a quick recap of the agenda for today. We're going to do an introduction, introduce ourselves. I will then cover the crypto landscape. We will have an overview of taxation. We'll run through some of the common misconceptions that people have regarding crypto, and then we'll end with a quick précis of the future of crypto. So, a quick introduction. So, myself, I'm the UK Managing Director of eToro. I am also the chair of the UK Crypto Association. What is eToro? eToro is a multi-asset platform. What does that mean? It's one of the few platforms where you can go and purchase shares in Facebook and or Apple, and also purchase Bitcoin. Furthermore, you can mimic the trades and investment patterns of any individual on our platform. So if you like somebody buying the way they buy Bitcoin or the way somebody buys, I don't know, Facebook, you can copy their trades. Dion.
Thank you. Good afternoon, everybody. My name's Dion Seymour. I work from the Policy Tax Advisor in HMRC. I'm part of the Business Assets International Directorate. I've been working in 15 years in HMRC. I've covered a number of different roles here, and I'm the policy owner within the Financial Products and Services team, leading on development of HMRC's approach to the taxation of crypto assets. To Michelle.
Hello, I'm Michelle Robinson. I'm an Associate Director at Deloitte. I'm a private client practitioner by trade, where my role is to understand individual taxation. I've done an awful lot of work in understanding how crypto assets are taxed and have attended all of the roundtable tax meetings hosted by Dion at HMRC to debate how crypto assets should be subject to taxation within the UK. I'm also a member of ICAEW's Private Client Taxation Committee.
So I just want to begin by discussing crypto adoption, looking at the regulatory landscape in the UK, and also looking at the customers and type of profile of customers we have at eToro. In 2017, 2018, we all witnessed the huge demand when it came to crypto. Everyone from your hairdresser to the taxi driver was discussing Bitcoin. What's interesting about all of this is that the majority of this was done with a background of zero regulation or uncertainty when it came to regulation. But what we did see is we saw Bitcoin's price move from the $3,000 to the $20,000. We saw over 2,000 crypto assets being born, whereas 12 months prior to that, nobody had really heard of the crypto asset or cryptocurrency industry. In the UK, we saw a change in the customer profile. So at the start of 2017, we had what we call the early adopters, the individuals who understood blockchain and cryptocurrencies. In the middle of 2017, we started to acquire customers who were, I would say, software developers, but not really in the field of blockchain and cryptocurrency. Towards the end of 2017, the customer profile again changed. And these were what I would call the Monzo crowd, the individuals who have a Revolut card in their wallet or have a Monzo app on their mobile phone. And then furthermore, in 2018, or early 2018, the customers that we started to acquire were everybody. It was your hairdresser, it was the individual who, your taxi driver, the person you meet down the pub. On our platform, we've noticed two really big assets driving traffic. These is Bitcoin and now XRP. Previously known as Ripple. So these are the assets which customers are buying. I can't go into the reasons as to why they're buying them, but they have been the dominant crypto assets on our platform. What we've also realized in 2018 is that when the price moves, 2019, when the price moves, we had a huge secondary wave of customers, again, new customers coming onto our platform, which means that we've just reached the tip of the iceberg when it comes to crypto adoption here in the UK. Moving on to regulation, in 2017, 2018, there were a few countries such as China who banned cryptocurrency and crypto assets. In the UK, we didn't follow suit, which I have to applaud. Instead, the regulator set up what was known as the Crypto Asset Task Force, consisting of the FCA, the Bank of England, and also the Treasury. And their remit was to work with the industry in order to kind of come together with a risk-based approach when it came to regulation. So in the UK, a few companies such as Ripple, Coinbase, Cumberland, eToro, etc., set about creating an association called Crypto UK. And we, together with a couple of other associations and also the Crypto Asset Task Force, have been working over the past 12 to 18 months to see what the regulation should be like in the UK. So where are we today? So the FCA has come out with their final policy paper. They've said tokens such as Bitcoin will not be regulated. So they call these tokens exchange tokens. There are other tokens such as utility tokens, for instance. Think of them as a loyalty points or crypto assets such as Ethereum. They also won't be regulated. However, when it comes to security tokens, so for instance, if you issue tokens in a company whereby the individual who owns the tokens will receive interest or some kind of benefit in some way, shape, or form, they will class them as security tokens and they will be regulated as traditional securities. The Treasury, following on from this, will be producing their final policy guideline in Q4 2019. They will be pretty much following the 5th Money Laundering Directive and adding a few bullet points on top. So they'll be far more stricter than what's coming out of Europe when it comes to regulation. and they will require money laundering checks when it comes to assets such as Bitcoin, Ethereum, Ripple, etc. I feel in early 2020 we will get complete clarity, particularly in Q1 of 2020 we will have complete clarity when it comes to regulation on crypto assets. I think the UK is in a position where they've taken a sit back and watch approach rather than kind of use a hammer to crack a nut, and have been very, very supportive of the industry. I'm just going to hand you over at this point to Dion, who's going to now discuss tax.
Well, thank you, Iqbal. So, firstly, why crypto assets are not cryptocurrencies? Although terms are used interchangeably, they're not quite the same. Crypto assets are an umbrella term that encompasses much more than Bitcoin. As we just heard a moment ago from Iqbal, we also talk about some of the other types of tokens out there, which also include the likes of Ripple, using the soda name rather than XRP, Ethereum, Litecoin, and Bitcoin. Although these are more commonly called cryptocurrencies, it is our view that the types available act more like an asset than a currency. As it's as an area of rapid innovation, the market and the terminology we are sure which will be used will continue to change. But if we can think for a moment as to what exactly a crypto asset, and being technical for a second, it is fundamentally a digital asset that utilizes characteristics such as cryptography, peer-to-peer networking to regulate the creation of new units, verify transactions, and or secure the transactions without the intervention of any certain central party. Whilst crypto assets are generally decentralized, they don't have to be, and we are seeing some crypto assets which are far more centralized in nature. Today, the session will be more of a high-level overview on the taxation of crypto assets, and we will be unable to give an in-depth presentation on all aspects of crypto assets, and we won't be touching the detail of blockchain or distributed ledger technology. I would also say that this isn't about e-money, rewards, and loyalty points, although I noticed Iqbal saying that utility tokens are similar to loyalty points. We're not holding a similar type of view here. So it's just over 10 years since the inception of Bitcoin, when Satoshi Nakamoto wrote his paper in 2008. Since that time, crypto assets have captured the public imagination. Again, as Iqbal has mentioned in previous ago, it's been over 18 months since their peak valuation, but news articles continue to have a notable prominence across the tax industry and in the public. Bitcoin certainly remains the best-known crypto asset. It came into existence in 2009 when the first token was minted, the Genesis token for Bitcoin. However, Bitcoin is not the only crypto asset that exists, and there are now actually near enough 2,500 tokens available. However, Bitcoin does remain the most widely known and the most dominant in terms of market cap. Besides Bitcoin, Ripple is becoming more popular, as we say, but obviously I'm not going to opine on that any further than Iqbal already has. Control with crypto assets are slightly different than what we are used to seeing, because control works through the distributed ledger that constantly grows with a list of records called blocks, and that's as far as I'm going to touch on the actual distributed ledger technology. Iqbal kindly highlighted some of the different types of tokens. So HMRC, we recognize there's actually 3 different types of tokens within the taxonomy. Exchange tokens, utility tokens, and security tokens. I'm not going to go over those any more than Iqbal already has, but we again appreciate that it's a fast-moving and developing sector with implications for all heads of tax within HMRC. We are sure that the terminology, types of tokens, and transactions can vary, and the tax treatment of crypto assets will continue to develop due to the evolving nature of the underlying technology. As such, HMRC will look at the facts of each case and apply the relevant tax provisions according to what has actually taken place rather than by reference to the taxonomy. I'm going to refer to the guidance now. So on the 19th of December 2018, HMRC released guidance on the taxation of crypto assets for individuals. This remains one of the most detailed guidance papers on crypto assets released by any tax administration worldwide. 3 papers were released at that point. The main paper is called Crypto Assets for Individuals, provided detailed guidance that covers many matters that have actually been raised with HMRC. If you have questions relating to the view of taxation of crypto assets from HMRC's perspective, this should be your starting point. We also released 2 further papers which serve to provide more practical guidance on crypto assets for individuals when they sell or receive them. These are actually aimed at helping unrepresented individuals complete their tax returns, so there's far more of a practical nature. I'm going to hand over to Michelle now.
Thank you, Dion. I'm now going to touch on the most common tax issues for individuals, focusing on exchange tokens, being cryptocurrency such as Bitcoin. Individuals may primarily acquire their cryptocurrency through two main mechanisms. Firstly, they may mine it, which is broadly being involved in the creation of Bitcoin or other cryptocurrencies in some way or another. So some activity has been taken. The other way by which people may acquire cryptocurrency is to acquire existing coins, and that may be done by way of purchasing cryptocurrency on exchanges. Now, the two different mechanisms by which individuals can acquire their cryptocurrency affect the tax position. Individuals who are mining are producing income, and normally such individuals will be taxable as though they receive miscellaneous income, being income that falls short of being a trade. The gross income such individuals receive is the value that they received during the tax year. So any means by which a miner receives value is income for tax purposes and must be taken into account when working out the tax due. Revenue costs can be deducted when working out the net income which is taxable for the year. That can be matters such as electricity costs, which increase if a miner leaves their laptop running overnight. The maximum tax rate that apply to individuals in this circumstance is 45%, that being the general non-savings income tax rate. Basic rate taxpayers would instead pay 20%, higher rate taxpayers 40%. And whilst miners are subject to income tax when they initially receive value as a result of their mining activities, if they keep their cryptocurrency with a view to benefiting from any increase in value of the coins, any change in the value of the coins may be taxable as capital as opposed to income, being at that point the miner has already received their income and they are now retaining the assets they've received as an investment. Now, the other mechanism by which individuals acquire their cryptocurrency is to acquire existing coins. As I say, that could be by way of purchasing them on an exchange. These are capital investments, and therefore gains or losses are within the scope of capital gains tax. The maximum tax rate is 20%, where capital gains tax applies. 20% rate applies to higher and additional rate taxpayers. Basic rate taxpayers instead will pay 10%. The tax point is disposal, and we'll come on to exactly what that means in this context shortly. And the net gain is what is taxable, and that is the disposal proceeds less the base cost for capital gains tax purposes. There is also an annual exemption that can be deducted, which we'll illustrate in the examples. When working out the gain or loss on disposal of cryptocurrency, we apply the rules that normally apply to shares, and we have some examples coming up on that in a moment. Now, in both cases, it is possible that individuals could be trading instead of having miscellaneous income or instead of being subject to capital gains tax. However, that would be very unusual. HMRC's view is that only in exceptional circumstances would individuals buy and sell crypto assets which have frequency, level of organisation and sophistication that the activity amounts to financial trade in itself, which means that in general we will be looking at the miscellaneous income or capital gains tax. Trading income would be quite unusual, but it could still happen depending on exactly what an individual is doing and how active they are. So we'll move on now to some examples to illustrate taxation in this context. Example 1 is a miner. Now this is Mr. A. He is a cryptocurrency miner, and he mines by leaving his laptop on overnight with the programs he uses to mine running. He is a higher rate taxpayer and is UK resident and domiciled. In the 2018-19 tax year, for which we're currently doing tax returns, Mr. A received cryptocurrency worth £2,000 from his mining activities. Because he left his laptop on overnight, his electricity bill went up as a result of his mining, and he estimates that his bill went up by £200 due to the mining activities he undertook during the tax year. That means that his net income is £1,800, being the £2,000 gross income less the £200 costs. Mr. A isn't doing enough to meet the badges of trade, so his income is taxed as miscellaneous income. The badges of trade being matters such as frequency of activity, risk, and so on, which indicate that a trade is being undertaken as opposed to a casual activity which falls short of being trading. Despite being miscellaneous income, Mr. A is eligible for the £1,000 trading allowance. Now, this is an allowance that was introduced within the last few years, which was intended to apply to matters such as casual income, so trading on, let's say, on online platforms and so on, where people were making a small amount of income every year, so that people didn't need to file returns to disclose small amounts of income where there would not be much tax at stake. The trading allowance works as a £1,000 deduction from gross income. So instead of having net income of £1,800 being the £2,000 gross less the £200 cost, Mr. A can instead deduct the £1,000 trading allowance from his £2,000 of gross income, giving him net income that is taxable for the year of £1,000. That £1,000 is taxable at Mr. A's marginal rate of tax, that being the rate of tax he pays, at 40%, giving a tax bill of £400. Now, moving on to an example of somebody who is investing. Ms. B owns 1,000 coins in a single cryptocurrency. Could be any cryptocurrency. We're using an example of Litecoin. She bought 400 of the coins on the 1st of January 2015 for £350. These are purely illustrative figures. She bought the remaining 600 coins for 1,150 coins, £50, on the 1st of March 2017. She has 1,000 coins with a total base cost of £1,500, and that goes into her Litecoin cryptocurrency pool. Now, the reason we're doing that is because the rules that normally apply to shares apply to cryptocurrency. That's because cryptocurrency is a fungible asset. It's most similar to shares, and it falls within the definition of things that are within the share pooling rules. So when we work out the gain or loss, we would use the average cost of the cryptocurrency to work out the gain or loss on disposal, unless another rule applies, which we have in the next example. Ms. B sells 800 of the coins that she holds on the 4th of February 2019 for £20,000. Her gain is computed by taking the proceeds, being £20,000, and deducting the cost. Now, we have our A over A plus B formula that applies where we have a part disposal of assets, which is relevant here. So we're taking 800 of our coins out of our total coins of 1,000 times by our total base cost of £1,500, meaning that we can deduct £1,200 from the £20,000 proceeds. Her chargeable gain is £18,200. She has her annual exemption for the year of £11,700, giving a taxable gain of £6,500. 20% capital gains tax is due on the taxable gain, giving a tax bill of £1,300. Our final example is to illustrate the rules that can override taking the base cost from the share pool. And these are the same day acquisition or purchasing cryptocurrency within the 30 days following a disposal rule. So if you follow on from the previous example, Ms. B purchased 800 coins on the 1st of March 2019 for £25,000. She previously sold 800 coins on the 4th of February 2019 for £20,000. That 1st of March acquisition is within 30 days of the 4th of February disposal, so we apply the 30-day rule. Ms. B is instead regarded as having disposed the coins that she newly acquired. So instead of having the capital gain that we computed previously, she now has a capital loss because the value of the coins has gone down in the 30 days following. So she has a capital loss of £5,000, which she can claim on her tax return. There is also a same-day rule, so if Ms. B had instead acquired the new cryptocurrency on the same day as she disposed of it, you match the same-day acquisition with the same-day disposal to work out what the gain or loss is. In this example, we've treated her as disposing of the same number of coins as she purchased. So it's simple. If you have a number of disposals, you may end up with some cryptocurrency having been purchased on the same day or within the following 30 days of the disposal, with other coins being sold from the pool. The same-day rule would take priority over the 30-day rule, which in turn takes priority over the cryptocurrency pool. Now, there are some common misconceptions with regards to cryptocurrency, which we'll touch on now. Firstly, there is a perception that investing in cryptocurrency is gambling, and because gambling is exempt from taxation, you shouldn't need to pay tax on your returns from cryptocurrency because you've undertaken a transaction in the nature of gambling. HMRC do not consider cryptocurrency to be gambling. They had some previous guidance, which I'm sure Dion will mention shortly, which referred to speculative activities which may be within the scope of gambling, but the general rule is that if you have cryptocurrency, such as Bitcoin, Litecoin, and the like, you are not exempt from taxation. Cryptocurrency gains and losses are taxable or relievable, as they are of any other chargeable asset or taxable income. Secondly, because of the name, people consider that cryptocurrencies are monetary currencies. And that's important because monetary currencies are eligible for certain exemptions from capital gains tax. Sterling is not a taxable asset. Other foreign currencies may be exemptions due to personal use and similar exemptions that can apply. Cryptocurrency is not a monetary currency and so is not eligible for those exemptions. Gains and losses are fully taxable in the usual way. And finally, there is a misconception that if you don't get any cash, you haven't got anything to tax. A disposal is any means by which you dispose of your cryptocurrency. So that can be a straightforward sale for cash. It can also be exchanging the currency you hold for a different cryptocurrency. Despite the fact you haven't received any cash, that is a disposal for tax purposes, and you need to compute the gain or loss on disposal and pay tax on it. So if you give up your Litecoin and instead purchase Bitcoin, you have disposed of your Litecoin and need to work out the gain or loss, and you have acquired Bitcoin, and you then need to keep a record of the Bitcoin you have acquired, and that will go into the pool or be matched to same-day or 30-day disposals. And with that, I will reference an infograph which eToro have produced, which is available for download, which summarises the key tax aspects of cryptocurrency with some key quotes on there. And I will now hand over to Dion.
Thank you, Michelle. So I'm going to mention a bit about the practicalities for record keeping. As a point of note, we should consider this because the onus on record keeping is on the individual, and the records that each individual should keep should separate each type of crypto asset and include, at the very least, the following details that you see here. So the date of the transaction, if it is a purchase or sale, the number of units of the crypto asset that's been acquired or disposed of, the value of each transaction in sterling, and optionally, a cumulative total of the units held. Keeping these details will obviously help you calculate the pooling calculations that Michelle mentioned previously, and ensure that you have got all necessary records to calculate any gains or losses that have arisen on the disposal of your crypto assets. When filling in your tax return, the value needs to be in sterling at the time of the transaction. So where a crypto asset has been purchased or disposed of, you will need to convert that into sterling. This can be done by either ascertaining the dollar value or that of another fiat value and converting that to sterling at the time of the transaction. If you have been buying and selling crypto assets or have made gains or losses, you will need to consider whether you have a reporting requirement for under the SA return principles. Please refer to our guidance for further information, in particular the guidance I mentioned before on the practicalities of capital gains for the selling crypto assets. One of the main differences that we have actually found with crypto assets is where they match on the exchange. So an exchange acts more like a introductory agent, and where they will actually match buyers and sellers. What can then happen is when an individual commits to a transaction to buy a token or a number of tokens, this may not be possible to be fulfilled in one go to one party. This will result in the records being provided for a number of different lines that can relate to one particular trade. So whilst it might appear to be one transaction, there may be multiple lines for that transaction. It does not follow that there have been an equal number of transactions as there may be listed by lines on the records. So a particular note needs to be borne in mind there for agents when reviewing your clients' details from their exchanges. Valuation. Where payment for crypto assets is given in the form of tokens, for investment purposes, for example, the normal CG calculation rules apply. You convert the crypto asset to sterling at the applicable rate at the time of disposal. You can get a post-transaction valuation check for capital gains purposes by submitting a CG34, and this is available on our website. Further guidance on the valuation of shares and assets and valuation is also available too. Disclosures. We want to help people get their tax affairs right, and we believe that taxpayers want to get it right. Capital gains can be declared either annually by submitting SA returns or immediately through the Capital Gains Tax Service. If the correct amount of tax has not been declared to HMRC, the Digital Disclosure Service, DDS, gives individuals and companies a chance to bring their affairs up to date in a simple, straightforward way. More information is available on our website as making a disclosure. Employment. We'll now briefly consider what happens when tokens such as Bitcoin are provided for your employment. The tokens received by your clients as earnings will be subject to income tax as money's worth. Crypto assets, such as Bitcoin, are considered to be a readily convertible asset, RCA, as defined by Section 720 ETIPA 2003. The employer is required to deduct or account to HMRC for the income tax due on the operation of PAYE when provided as employment income. The amount of PAYE income on which the employer must account for income tax is based on the best estimate that can reasonably be made. The provision of an RCA is a notional payment on which the employer is required to deduct or account to HMRC for the income tax due. The amount they are required to account is the due amount. Your clients are obliged to make good the due amount to their employer. If they do not make good this amount within 90 days after the end of the tax year in which the notional payment is made, then a further charge to income tax will arise on the amount equal to the due amount under Section 222 ETIPA. Employment income is taxed on a receipts basis, so if an employee is paid in tokens, the tax point would be the point of receipt, or to put it another way, the point at which the employee receives the payment or is entitled to receive the payment. Please note that for any tokens that are received and then held by the employee for any period of time, there could be a subsequent CG charge on their later disposal. I've highlighted employment mainly because we've had other tax authorities actually highlighting how they are dealing with the treatment of employment for Bitcoin. I'm now going to hand back to Iqbal.
Thank you, Dion. So before I discuss the future of crypto and tokenization, I just want to thank Michelle and Dion. I would never have thought that tax could be so interesting. So moving on to future crypto. If we want to have a look at the future of crypto, we need to step back in time and look at the internet and compare it to the internet. 25 years ago, this thing called the internet was born, for want of a better word. The internet and I would say blockchain on which crypto is built are very, very similar. The internet was all about communications, and the first use case was email back in 94, 95. The blockchain is all about value, and the first use case was currency, i.e. Bitcoin. Since then, however, over the past 20 years, the internet has given rise to a multitude of use cases, from e-commerce websites to social networks, to casinos, to you name it. There's all different types of businesses available on the internet. This is now similar also to the blockchain. We started off with currencies. We started off with Bitcoin. We started off with Litecoin. We have now moved to social networks such as Steam on the blockchain. We also have casinos on the blockchain. We also have e-commerce stores on the blockchain. These all use crypto assets in one way, shape, or form. So I'd like to remove the misconception of that there's 2,000 cryptocurrencies out there that we're going out and spending tokens such as Gnosis. We're not. There's 2 or 3 or maybe 5 different types of cryptocurrencies. The others are investments in various types of businesses on the blockchain, which brings me on to tokenization. We at eToro are firm believers that the future of crypto and the future of investing is based around tokenization. So as I alluded to earlier at the start of the presentation, on eToro you can go and buy shares in Facebook and you can buy Bitcoin. We believe in the future shares in companies will be tokenized, Other assets and investment classes such as wine and property will also be tokenized. So individuals such as yourselves can go and buy a token in a property, say in China, as easy as you can buy Bitcoin today. Where's the value in that? Well, we call it liquid investing, where you can go and spend your investment in property as easy as you could spend Bitcoin, or as easy as you can spend using your credit card today. And what that does is opens up the world of investing to everyone, where your investments aren't tied up anymore. So what's the future of crypto? I would say it's very bright. For us, the future of crypto is tokenizing the world of investing and creating a multitude of asset classes. And on that note, I'm going to say thank you to one and all and open this webinar for questions.
Thank you very much, Iqbal. Well, I actually think tax is very interesting and very exciting, so I'm not at all surprised that we have enjoyed speaking to our listeners today. Well, we've got a stack of questions here, so let's take it from the top. Would you like to just answer well, this one is made for you, Iqbal. How do I buy tokenized assets?
That's a really interesting question. So I would say the tokenized assets you can purchase today, or what is our virtual tokenized assets, are the coins such as Bitcoin and Ethereum, etc. So you can go to numerous exchanges. We all know the usual suspects: Coinbase, eToro, Binance, etc., where you can purchase them. Or what I would call the next wave of tokenized assets, i.e. tokenized property. There are very few exchanges, if any, where you can actually purchase them outright today. So we may have to wait 6 to 12 months before we're going to purchase them. So the new types of virtual ones available today. The other 6 to 12 months, they'll be available on the same exchanges.
Okay, thank you very much. We've got one here from someone called Cosmin. They've asked us, does this mean I need to keep track of all the transactions I've made? My guess is yes.
Absolutely.
Yes,
that's
you do.
Yes, Anita.
I think everybody agrees yes. Go on, Dion.
Okay. As we mentioned earlier, each disposal is a taxable, a chargeable event for capital gains purposes. You need to keep those details so you can actually calculate your tax liability if one indeed actually arises. Michelle, any thoughts?
Yeah, I echo that. Clearly, you need to keep records of disposals and also the acquisition, so that you have details of your costs, so that you can work out what the gain cost is.
Sorry to interrupt. You were talking about filling in tax returns earlier. Presumably, a lot of people who are investing in these sorts of assets may not have engaged with HMRC specifically through the tax return before. Does the 5th of October deadline for asking to be put into self-assessment apply here too?
It does. So if an individual needs to notify HMRC that they have an income or capital gains tax liability, they would need to do so by the 5th of October following the tax year. Whether or not the individual needs to notify will depend on, well, if they have income which is taxable and their income is above the available trading allowance, they will need to notify because they will have an income tax liability. And for capital gains tax purposes, they will need to notify if their capital gains in the year are above the annual exemption or 4 times the proceeds, which is the threshold for notifying HMRC that a tax return is required. But there's guidance on the Revenue website that summarizes when notification must be made.
We've got a lovely one here, Michelle. This person's asking, do students in Scotland have to pay tax? I'm not going to name the person that's asked it.
In the UK,
so students at university in Scotland pay tax. I guess it's students who are happily mining some of these things.
Yeah. Anybody who makes income must pay tax. It's just that most students don't receive a sufficiently high level of income that they would be above the personal allowance for the year.
Yes, it's safe to say there's no derogation from tax legislation, particularly for students in Scotland.
And would you like to pick up this one as well? Someone's asking, is there an age restriction? There's a whole other world of people investing in these things. So I presume they mean I'm 15 and I've done terribly well out of this. Am I exempt from tax?
Again, there's no minimum age for the application of tax. Okay. What you would recommend is that you speak to your parents. So you can seek proper advice.
I've been selecting questions at random. Let me just ask our guests whether they have any particular ones that they rather fancy answering. Iqbal, choose a question.
Okay, so this question is, how do you value a cryptocurrency in pound terms? So, an interesting question. I think it's at whichever point. I think this is relating to the volatility of cryptocurrencies. So, they can vary by 10 to 20% within a day. But like any transaction, there is a point in time and there is a timestamp when you buy or sell the asset, and at that point there'll be a dollar value assigned to it from an exchange, and at that point you can actually go to websites like xe.com and saying, well, this is the pound value. There are other ways of actually doing this as well. They're just referring to the question prior to this, where do you need to keep a record of your transactions? There are now calculators available out there, and I'm about to do a plug that eToro has one, which allows you to import all your transactions from multiple exchanges and do the calculations for you on your tax returns. So there are tools out there to enable you to do these things now.
Picking up on another one, this is specifically to eToro. Will says, will eToro provide statements by tax year?
All your transactions at eToro are kept and recorded, and should you want all these transactions, they're all in your accounts, in your statements. So short answer is yes.
Thank you. Michelle, you're not actually with us in person, so I can't see to wave at you. Are there any questions that you particularly would like to answer?
I think I'll pick up the question, which is, can you roll forward the crypto loss? And the answer is yes, you can. If you are a miner and you have made a loss for the year, then that being your expenses exceeding your gross income, then yes, you can roll that forward to future mining income. You can't claim a loss based on your trading allowance. So if you have income of £600, you can't deduct your £1,000 trading allowance and give a loss of 400. That just reduces your income to nil. But if your mining has incurred a loss compared to expenses, then yes. And if your business gets a capital gains tax and you make a loss, yes, you can use that loss. It first goes against the current year gains. If you aren't able to use your capital losses in the usual way for the current year or for carrying back, then you can carry it forward to future years. You must claim your loss, though. So you need to put in something to claim the loss for the tax year in question.
Thank you very much, Michelle. There was another question that's related to the trading allowance. In your example, you had a £200 electricity cost. Perhaps we should just make it clear that if you're using the trading allowance, you can't use actual cost as well. Someone asked where the £200 cost had gone. That's correct, isn't it?
Yes, that's correct. It's either expenses or the allowance.
Yeah. And of course, if you have a self-employment or a business apart from your trading in your coins, you wouldn't necessarily be able to use that £1,000 deduction, would you? You'd have to look at both businesses together.
Exactly. You get one allowance for the year, and you can choose what you do with it. Yeah.
Guests in the room are busy looking at questions. We have one here at the top. What could regulation mean for crypto and the future of crypto?
Well, I'll take that one. I think there's four parts of the jigsaw puzzle if you want crypto to succeed. The first part of this is regulation. The second part is providing what I call structured investment products such as ETFs. The third part is custody solutions, where you can actually store your crypto with third-party providers. And the fourth is utilization, being able to spend crypto somewhere. So I think regulation is the first part. I think it's a positive move. We surveyed our customers, and I can't remember the exact percentage, but the majority of them actually came out in favor of regulation. Whether that gives them a sense of security or a stamp of approval, that's something we need to ask the individuals. But what it does do is actually give that credibility and allows other businesses start to accept crypto and now offer services, whereas today I think they're sitting back. And a lot of the corporates are actually saying, can we do this, can't we do this? And I think we need to have clarity. So I think regulation gives us clarity, which is really supportive of crypto.
Dion, do you have a question?
Yeah, I'm going to pick up the one on the reference to our 2014 gambling guidance referring to gambling, if that's okay. So thank you on that question on there. Michelle did touch upon the gambling point earlier, but I just would like to clarify that the Revenue Customs Brief 914 never said that transactions with Bitcoin or other crypto assets were gambling. to quote the brief itself, it said the relevant legislation and case law will be applied to determine the correct tax treatment. Therefore, depending on the facts, the transaction may be so highly speculative that it's not taxable or losses relievable. Periods, full stop there. Now, for example, gambling or betting wins are not taxable and gambling losses cannot be offset against other taxable profits. HMRC hasn't changed this view. The position is that gains from investment activities involving crypto assets have always been subject to tax. Unfortunately, this is a misconception that has continued for a while, and HMRC explicitly rebutted this in the recent guidance.
Thank you. Ram, we've got another one here. Are token wallets secure?
Again, the easy answer is yes. So token wallets are fundamentally secure, but they're only as secure as the key that you use to access them, such as similar to anything on the internet itself. There are various different types of wallets. There are software wallets which are available online. There are, of course, the hardware wallets which you can keep in your drawer at home. But I would, what I would caution with any of these wallets is it's as secure as the key. And having said that, if you lose the key, there is no way of extracting anything out of that wallet. This is not like I've lost my bank card, I can go to the bank to get a replacement. If you lose your key, you have lost all the money in that wallet. So it's similar to losing cash in your wallet. If you lose the cash and it falls out, you are not going to get your cash back. So secure the key. Whether you secure it yourself, you secure it with a partner, you share the keys, however you want to secure the keys.
Oh, thank you. Well, you said that was an easy one, so I'll have to give you another one after that then. I might even push this one to the screen so everyone can read it. About tracking. Push it to the slide area. Here we go. Do we need to track from normal banking to Revolut or Monzo the conversion to eToro and then every buy-sell valuation? And for every step, they must be converted to pounds, must they?
So I'm going to answer this one, but I'm going to let Dion then take it on from there and Michelle. So my understanding of this is you purchase crypto and then you sell, you buy crypto and then you sell crypto, and that's the transaction that HMRC will be interested in. But I'll let Dion take this on.
I'm just going quickly on the Revolut app. As far as I'm aware, you can't actually transfer what you hold there out in terms of to another one. You have to dispose of it. So when it comes to pooling, if you have Bitcoin across a number of different exchanges, a number of different wallets, that will all go into the same pool. Doesn't matter how many different wallets you actually have, but here you can't transfer it to another wallet with Revolut. You'll actually have to dispose of it to transfer it into something else, whether it's fiat or another crypto asset. And so then, each buy and sell would have to be converted to GDP and accounted for accordingly.
Michelle, did you have anything you wanted to add to that one?
I think Dion's answered that question nicely.
Lovely. Right, how about this one? Will the tax levy apply to all crypto assets? Exchange, security, and utility tokens? If not, what kind of tax will apply to other types of crypto asset? Okay,
I'll take that one. Slightly obscurely questioned. In terms of a crypto tax, there isn't actually a crypto tax. What we are taxing crypto assets in line with the activity that they're actually involved with. So, for example, investing will be a capital gains transaction. However, if they are trading, then that will come under income tax. So we aren't taxing the token itself. We are taxing what the underlying activity actually is, as we do in line with other assets.
Okay, now I'm looking for a question that I saw earlier on the situs of assets. I can't quite see it, but it struck me that where these things are could be very, very relevant. Can you see it? Okay, Dion, go for it.
I found that there are a lot of good questions here, has to be said today.
I know. I think we might try and do a written tax guide afterwards to inform people. People are nodding here. That's great. We've got enthusiastic response for doing some written Q's and A's. Great. Okay, go for it. So
the question was, in respect of residence and domicile matters where crypto assets are held in the name of an individual, how is the location sourced by jurisdiction? Bitcoin, so I'm trying to expand the window. Bitcoin, for example, is stored in a public blockchain and thus will be stored globally on every computer running the Bitcoin client. Will the assets therefore, in the event of an individual who is a non-domiciled remittance-based user, be considered overseas or domestic assets, and thus by extension where gains are realized overseas or domestic gains? Will a split be required by a recognized base extension where gains are realized overseas or domestic gains? It is a very good question.
We just pushed that one to the side area. It's such a long question.
What I can say there is thank you for that. The question, HMRC is very aware that situs on crypto assets is a live issue. HMRC is considering its position and has no published view on the matter at this particular point in time. When a view has actually been formed, this will be published. In the meantime, if the source of situs affects your client's position, we encourage you to set this out in the return, particularly for individuals in the white space box, for the position that you've actually adopted, which will obviously minimize the chances of any unnecessary inquiries from HMRC on this matter.
Okay, thank you. I've got a question here from Oleg. How far back can one claim capital gains tax losses on crypto? Can CFD transactions on crypto be included? Who would like to take that one? Michelle, are you there?
I am. Could you just repeat the question, please, Anita?
Yes, I've just pushed it onto the screen, actually, Michelle, so you should be able to see it coming up now. How far back can one claim CGT losses on crypto? And can CFD transactions on crypto be included?
So you need to claim losses within 4 years from the end of the tax year. So the tax year ends on the 5th of April, so the next event we have coming up is 2020. So you can claim tax years for the 4 tax years that end on the 5th of April 2020.
Thank you. So and any normal losses rules, yeah?
Normal losses rule, no special rules for cryptocurrency, just the usual 4 rules, 4 years from the end of the tax year.
Absolutely. Completely agree with Michelle.
Thank you. Got one here about companies. What happens when a company acquires cryptocurrencies?
In what capacity is a company actually acquiring the crypto asset? Is it actually being used as
part
of it? And this is the fundamental point of crypto assets, is that we have to look at what the underlying activity is actually being performed so we can actually identify what the taxation treatment will be. If it's actually using it as part of its stock in trade, so if they are buying and selling them to make profit, then that will go under the income, and then we'll obviously be looking at that being more of the normal CT under Part 3. If it's actually being acquired as an investment, then we will come to the chargeable gains for capital gains equally as it would, because it wouldn't be applicable to Part 3 of CTA 10, Part 5, 6, or 7. So it would just be go through to the catch-all of the CG. But it really does depend on what the actual circumstances are behind the acquisition.
Thank you very much. We have one here. Oh, this one comes from Deloitte, so I think that this one has to be for you, Michelle. It says, are transactions of crypto assets and cryptocurrencies subject to or within the scope of VAT or other indirect taxes?
Ooh. I think
if you're trading, could they be? I don't know.
Well, I'm happy to take that, Michelle, if you want. Or...
if you wouldn't mind, Dion, yeah.
Yeah, I think it's a bit... so for the VAT, sorry, could you push that to the screen?
I just did,
Wonderful.
It's there.
So what we're actually looking at here, crypto assets themselves don't necessarily actually attract VAT in of themselves. What we'd actually be, once again, as I said before, we're looking at what the transaction is. So if you have a good or service that has been provided and the consideration that has been provided is in the form of an asset, then you will still be looking at calculating that the same as you would if any other asset had actually been used to acquire that good or service. So if you are selling widgets and someone has come along to you and has presented a different widget, that will still be consideration for VAT purposes.
Thank you very much. And while we're looking at other taxes, we've got one here on inheritance tax. Let me just push this to the screen. We focused on income tax and capital gains tax. Are there any points that the panel would raise in relation to inheritance tax, valuation, for instance. Any thoughts on that?
Fundamentally, we'd be looking at the same way of calculating the valuation as we would for CG purposes.
Thank you very much. Okay. We've had a couple of questions on information. This person is asking, what if your broker does not supply the information? Well, this one actually relates to pounds. Some of the others were saying does not supply the information at all. But do you want to just handle the pounds one first of all?
Which question is that?
I've just popped it up on the screen there. What if your broker does not supply the information in GB pounds?
Well, I think the broker, I mean, it's entirely down to the broker in what currency they supply the information in. And I think, Dion, correct me if I'm wrong, and Michelle, I think it's up to the individual to calculate that information in the currency required by the local tax office, which is GBP. So yeah, that's how I would answer that. Unless anyone else, anything different?
Absolutely, you have to convert it to sterling. Yeah. Oh, sorry, Michelle.
I think we were saying the same thing, that the tax has to be calculated in sterling, and if that means converting via a different currency, because that's the information that you have available, whether that be a monetary currency or a cryptocurrency, then that's what needs to be done.
Absolutely. As I mentioned earlier in the presentation, most crypto assets you can actually convert to dollars. I pretty much see a dollar valuation for every single token I've really looked at. Once you've got your dollar valuation, then, or any other fiat, obviously, then you can then convert to sterling at that particular point in time.
Yeah, great.
We have one here on, it looks like it might be rollover relief. Can gains be rolled over? If the taxpayer has no cash, then how can they pay their tax bill?
Gains cannot be rolled over. There is no rollover relief for crypto assets, the same as we mentioned before. If there's a disposal, there is a disposal that is a chargeable event. It does create a dry tax charge, which we are aware of, and what we would recommend is that when they actually do their transactions, that they manage their affairs accordingly. Similar circumstances can obviously occur elsewhere in an investment arena. For example, when you dispose of shares, you can then quickly reinvest all the gains and all the proceeds that you've actually received, and unless you put unless you manage your affairs to make sure that you've got the necessary capital at the end of the year to actually pay it, the fact that you've just reinvested it and is tied up again in what could be a potentially liquid asset doesn't mean that the liability from the year hasn't arisen.
Thank you. We've got one here on employment tax. This one is asking, I am paid by my employer partly in utility tokens. I pay national insurance and income tax on this income. That looks more like a statement to me. Would you like to comment on that? It's perfectly reasonable.
As I mentioned previously, we certainly would see crypto assets where we can actually ascribe money's worth there to be considered to be a readily convertible asset, and paying national income tax and national insurance and income tax on that is part and parcel with the sections I mentioned earlier on employment. So as long as I think that, as I say, it's a statement, in which case I wholeheartedly agree with the position taken by the employer.
Okay, and we've got one here saying, what if your broker or the exchange doesn't supply the information at all? Go elsewhere?
Well, I couldn't possibly comment on that. I'm not too sure of circumstances where they wouldn't provide it. So
I would be very surprised if a broker did not either have access or didn't supply this information. Just from a checks and balances perspective, they need to have this information internally. So I'm not going to say go elsewhere, but again, I'm sure Michelle and Dion will agree. Ultimately, the responsibility is on the individual who's purchasing the assets to keep a record of those assets. But I would say if a broker cannot provide you that information, then I would have a serious conversation with the broker.
Yeah, thank you.
Absolutely. As I said earlier, the onus on retention of records is upon the individual. It is their own tax affairs that they need to manage.
Okay, thank you very much indeed. We will be sending a link to this webinar to all of the people who have registered to receive it. So whether you've listened today or you have a colleague who didn't manage to get on live, you'll receive that after this webinar. You will also be asked if you could give us some feedback, which will be really, really helpful, please. So did you enjoy it? Did you learn lots of things from it? Are there other things that you would like to hear from us about? We have also agreed to do some questions and answers, so we've got such a lot of really good questions. We'll be looking at those once we come off air. But it leaves me just to say thank you very much indeed to our three speakers for today. Iqbal, Dion and Michelle, thank you very much indeed for your time.
Thank you.
And thank you all for listening. Thank you very much.
Thank you.